What if I told you there was a company yielding 8% and just increased its dividend by 5%? Would you be interested in them? Well, the good news is Legal& General, ticker symbol LGEN, has just done that. But the question we always ask in Dividend Talk is that dividend safe? And that's the question that I hope to answer in this video. Now, before we dive into Legal & General, I wonder if you could do me a huge favour. We know from looking at our statistics that 46% of you are not subscribed to this channel. I have a goal of reaching 2,000 subscribers, and I'm wondering if you could help me and please hit that subscribe button. But anyway, let's get back to Legal & General. So Legal & General is a company that has been around for quite a long time. It was founded in 1836 by 6 lawyers who had a passion to regenerate Britain's towns and cities. Now, you can imagine with over 150 years in existence, the company has gone through major changes. And as of today, they operate in 3 main business segments. Now, their biggest segment is institutional retirement, and this makes up of over 50% of the company's revenues. So this one is quite important to understand. And this segment helps companies to de-risk their pension obligations. Now, it does this using various different methods, such as buy-in and buyouts, insured self-sufficiency policies, and longevity insurance. And it's not just limited to the UK. They also have a division in the United States called Legal & General Retirement America. Now, their second business segment is their asset management segment. And this holds roughly $1.3 trillion in assets, making it the number 1 UK asset manager by AUM and number 11 globally, which I think is quite impressive. And then the last segment that they have is their retail division, which provides life insurance, savings and retirement products to people like me and you, just normal individuals. And as you can see from their capital markets investor presentation from 2024, they're anticipating growth in all 3 segments. Analysing a company like Legal & General with such interconnected business units can be quite challenging. That is why I prefer to keep it relatively simple and focus on their track record over time. And some of the metrics we will look at is their solvency ratio, the return on equity, and even their growth in net income. Now, you might wonder, why the solvency ratio? Well, it's quite simple really. For financial companies, the solvency ratio is a good indicator of financial strength. And regulators often have specific expectations on the solvency ratio. For example, if it was to drop below 150%, the dividend would be immediately at risk. But if it is above 200%, there's ample room for shareholder growth. Now, when analysing the financial performance, it is probably a good place to start with the retirement institutional business. And as I said before, this makes up almost 50% of their after-tax profit. Now, I have to say that revenues from this was relatively flat from 2018 up as far as 2023. And it was quite clear that COVID had impacted that part of the business. However, we are starting to see some growth again, and we can see the 2024 numbers are actually quite good, with operating profit up 7% to just over 1.1 billion. The asset management part of the business continues to do quite well, and it was up 4% to 967 million, and this is despite lower than average asset under management. And finally, the retail business again did quite well in 2024, and its operating profit was up 12% to 504 million. For the retail business, you really want to consider the insurance gross written premiums. Or simply put, this is the total revenue an insurance company expects to receive from policyholders for insurance policies during a specific period. And since 2017, Legal & General have grown this at a compounded annual growth rate of around 5%. I mean, we could look at stuff like individual annuity sales for the retail retirement line. We could look at the direct investments metrics for capital business line. But really, this might not be beneficial because combined, they contribute only around 10% to the overall profit. But overall, the business has demonstrated slow growth since 2017 with a compound annual growth rate of around 3.6%. This is actually quite suboptimal, particularly when you consider some of the favourable economic conditions we've had over the last 5 years. So pretty much what we have seen is that the investment management unit and the retail insurance unit have not seen any growth in this period, while the institutional retirement segment has seen only modest growth. Now, looking at return on equity, the company target around 20% annually. And if you go back as far as 2015, in fairness, the company has consistently achieved this target. There are years such as in 2023 where the return on equity was around 12.5%, but this is due to one-off impacts that are mentioned under investment and other variances. And honestly, it doesn't raise any significant concerns as I expect it to balance out over time. Now, in terms of the solvency ratio, the company consistently meets or even exceeds expectations here. It has grown from around 160% in 2015 to 232% in 2024. So, given the low growth that they've had over the past couple of years, do they have any actual catalyst that will allow them to have this sustainable growth that they mention in their capital markets presentation? For me, the true catalyst is the aging demographics. As an increasing number of people may develop an interest in lifetime mortgages, this has proven to be a successful business model for them. Another catalyst for me is the growing opportunity to deleverage US balance sheets by assuming pension obligations. Now, you might remember earlier I spoke about our institutional retirement division and how it can assist companies in mitigating pension obligations. If you think of companies like UPS, there is a huge opportunity in the US for Legal in General to help companies like this to improve their balance sheets. Now, before we get into the dividend, let's summarize what I've talked about over 3 key points. The first point I want to make is that the institutional retirement business is the number one segment you should be looking at. If you're short on time and you want to keep an eye on how the business is doing, personally, I would focus my time there. I'm not saying the other 2 segments are not important, but this segment generates 50% of after tax profits, so it's definitely where you want to spend your most time. The second point I want to make is that profit after tax has been pretty much flat over the last 5, 6, 7 years. However, during the same period, return on equity has been consistently over 20%. This means that the company is very profitable and shareholder wealth is growing at a good return over time. And the third point I want to make is that they have a very high solvency ratio. Now, the benefits of this is that it gives them a good cushion in case we ever return to the low interest rate environment that we had before, but it also gives them plenty of cash to continue growing the business. Now, let's look at that dividend. After all, that is the reason why we are here. Now, what I like about this company is that it has a clear capital allocation policy. And the first thing on its list, and it should be, is that it wants to maintain a strong balance sheet and it wants to have sustainable capital generation from all their divisions. Once they have that, they have enough money to invest for future growth, and then any surplus capital will be returned to us shareholders in the forms of dividends and buybacks. Now, one thing I want to highlight is that there is a slight change in the dividend policy. What they are proposing is they are proposing a 5% dividend hike for 2024, followed by a 2% per year as far as 2027. On top of this, they have estimated a first buyback of around 200 million in 2024, and we expect them to announce further buybacks over the next 3 years. I definitely appreciate the company's very explicit dividend policy, but don't expect lots and lots of dividend growth. Historically, the 5-year compounded annual dividend growth rate was only 3.2%. But remember, you're getting a high starting dividend yield of around 8.12%. And in my opinion, this is a very safe dividend, which is not something you can say of a lot of companies with such a high dividend yield. So in my opinion, Legal in General are your classic example of a boring business that offers a high dividend yield but low dividend growth. I personally think the dividend is safe, so the only question left to answer is whether or not they are trading at a fair value. Now, we've done a full deep dive on this for our premium newsletter subscribers, and while I won't give away what the valuation was, what I will say is that I believe they are trading at around a fair value right now. With that said, I hope you liked this video on Legal in General. Please leave a comment below, and if you're feeling generous, hit that like button. See you next time.